Thank you, everyone, for joining us this afternoon after lunch. Very happy to see you here. To start, I will kindly ask our panelists to introduce themselves.
Hi everyone, I'm Antonis Patinios. I work for TMGM based in Limassol, Cyprus. I've been working there since August of 2024, starting freshly as a junior FX dealer, now an FX dealer. And this is my first ever expo and panel, so I'm quite excited.
Hello, I'm Lee Goldfarb. I am the liquidity sales trader at B2 Prime. Have been there for 8 months, but have worked in this industry for quite a while now. And I think this is my fifth final Magnates London, but the first one in magazine.
Hi everyone, my name is Chariton Christou. I'm the CEO and co-founder of Boltzmann Research, a firm specializing in quant optimization. Previously was working with Tickmill for almost like 7 years, heading the quants team, and indeed it's my fifth time here as well.
Fabulous. So we have some seasoned panelists and a new joiner. So we'll try to be kind to you. Right. So since our topic is the art of dealer, the risk management and the education in the industry, the first question I'd really like to ask is more about what makes a good dealer? Like, why do people come to this industry and what it actually is like to be a dealer and what makes a good one?
So I can start from the FX CFD perspective and my perspective, um, talking about instinct. Sorry, wait, can Lee start? Can Lee start?
No, don't worry. How should instinct and, in general, like the guidelines, what it should be the balance between it? What kind of an instinct should a dealer have?
Well, it's not learned instinct. It's instinct gained through looking through hundreds and hundreds of clients and trade history. So, mm, I'm a bit nervous. I'm a bit nervous.
Lee, would you mind helping out?
Yes, so I come from a more institutional background where we look at risk as a structural part of how you run your business. And for me, it's a lot less about instinct and a lot more about understanding your underlying flows, who's trading, why they're trading, what they're looking to trade, and what kind of risk you can actually manage. So you need to know your numbers very well. What is the net open position that you as a firm is comfortable in holding? What is the actual trade flows, how they behave, and how as a broker, how you manage them. So working on the prime side, we help a lot of white labels start up, build up. And the thing I always come back to is understand the product, understand the risk. And from there, you can start making decisions. But if you don't have that very mathematical understanding of what is your risk, what is the nature of your risk, and how it behaves, then you might be caught out by the market.
Thank you. Do you think it's different in retail? That's for both you and Chariton.
Well, I mean, in some extent, yes. So, for example, I totally agree with Lee. So, for example, you have to know your numbers. You have to have a mathematical understanding of your flow, and also of your pricing. So, at the end of the day, like what FX and CFD brokers do is that they have actually price that they stream to their clients. So, the dealer, they have to understand their risk, they have to understand their pricing, they have to understand some markups they do, etc. They have quite common things with institutional, let's name it, space, but there are some differentiators like toxic flow or whatever, but they share quite a lot of commonalities.
I'm ready to speak now. Thank you. What makes a top tier dealer? I think adaptability and not folding under pressure. Because as a CFD dealer, you have routine daily tasks, but you also have monitoring system health, going through reports, analysis of client flow, how to deal with flow if you have to take defensive measures. So I think it's a very proactive role filled with internal controls, monitoring live exposure, knowing whether to internalize or to STP flow. It's
You did not fold under pressure there, so thank you for that. How is the plumbing different, though? Lee, maybe you can speak a little bit about it between a retail and institutional provider. Are the tools used different? Because Sheraton, you mentioned spread decay and markouts. And we see finally that in the retail space, finally brokers start looking at it when, I don't know, 5 years ago, that was a very institutional metric. So how is that different, and how different are the tools?
So on the institutional side, the tools do vary now, thanks to things like your Bourse that is making markouts more accessible. It's much easier to get hold of those metrics and start building your business. But institutional will be able to see if that flow has high covariance. So if it's, a gold EA trader and there's lots of people trading in the market. So when it comes to signal-based flow, it'll be very easy for the institutional side to understand where that signal is coming from and what's happening, whilst retail brokers might not be able to see that. They'll just see markouts that behave in a certain way, but they can't see quite how toxic that flow is from the side of the price maker. So they do tend to have a bit of an informational edge over their clients, because they understand, but there's also the gap. Retail, they know exactly who the underlying client is. He papers with them and they have that relationship. Whilst the institutional space, they're just all tags on a screen. And that's where being a good provider, a good prime broker, becomes really essential, because you need to have that information and that communication between the LPs, what the LPs are seeing, what the LPs would like to see, and how you're going to build that relationship with the underlying retail brand. So that's, as someone who sits in the middle of that, is very important, because they'll be looking at metrics, but most of the time they're not the same metrics. So there's an information gap there that as a prime broker you have to gap.
Yeah, I kind of agree with Lee. Institutional space is a kind of different, and you have to be sure that the liquidity is there, like kind of every single time. You have to understand the flow from a kind of different perspective. You don't want actually to increase the spreads. You don't want to have unhappy brokers. While on the CFD retail space, you do care about it, but you also care about consistency of the price. You understand the markouts as well. You understand the risk, and when you send now, like, I mean, 5 years ago, when a dealer was sending a flow to a prime of prime, they most of the time they were not so sure how this flow is. Is it sharp? Is it toxic or whatever? However, nowadays you have markouts and they do understand themselves what they're sending. So it's also like better communication between the two parties, between a dealer and the prime of primes, because they both know what is out there.
I'm going to ask you a question. I think you're going to be perfectly capable of answering it. We didn't practice it, we didn't rehearse it.
No worries.
But so I've been talking yesterday to one of our partners, and what was really interesting about it, and Lee, maybe you have also an opinion in it. They pretty much said that VAR is cooked. It's all about stress testing now. And I don't think that retail brokers do any stress testing, or not as much stress testing as they perhaps should. So what's your take on that?
Yeah, I mean, most of them they do. Even though if you take like the top of like the top bottom, like the top 25% of them, most likely they do. They do some stretch tests. They do understand their risk that they have at any given point in time. I would say medium to kind of small. They're not that kind of. They don't maybe sometimes have the capacity to do so. So it's quite normal.
I think when it comes to smaller and medium brokers, very often there's a bit of a heuristic bias where they'll look at the markouts and the markouts are negative or positive. So they'll be like, oh, if I sit on it, I'll be able to make money in the B book. But the reality is they've built a huge position in something like gold because it's a highly traded commodity. They haven't looked at what their net open position and what their acceptable loss is. Gold moves 5% in a day. That can be very, very damaging if you have a significant level of B book exposure that goes one way. So it's looking at your book, looking at whether or not the book itself is skewed, and looking at how that affects payouts and net open positions. I think a lot of smaller brokers don't look at that, and that's really the downfall of them, is that they don't have that informational and operational understanding of what they need to be doing and how they should be looking and constructing that risk, because they'll sit on that risk and they'll go like, my markouts look good, but your clients don't need to be geniuses. They could have just opened a gold position over the last 2 years and sat on it, and they'd be deep in the money. And if you don't have a strategy around that, that can be very, very costly for you as a brokerage.
Yes, I agree. Antonis, my question would be more around education, right? So, do you think that dealers or new starters in in the brokers and B2B firms, do they have adequate training before they start in the job? And actually, is there formal education available for them to be able to receive before they get into it?
Great question. From our side, I joined TMGM with absolutely no dealing experience. I learned everything from scratch via shadow work through our heads, through our internal training programs. Um, for example, it was around 3 months of shadow work before my first ever hedge to not make a mistake. Uh, I had seniors, I had my team lead, I had our Australia team training every 2 weeks. We have internal training with a different head, which we suggest. Um, and that was quite useful. In terms of industry education, there's not much, especially when it comes to daily dealing routine. I actually took part in a program in Cyprus called FX Dealers Academy. Are you aware of it?
Yes,
uh,
I am.
yes, I was in the first cohort, and that was something very new in the industry. Great speakers, and I think that's the next step going forward to also not just allow dealers, but let's say people in marketing to understand what they're selling. It's very useful for the future.
You were a speaker at that first cohort. I'm going to ask you, what do you think in general in dealer education should be standardized, perhaps?
So I think our industry kind of operates a bit of black box. The only way to it's like a medieval guild. You have to be bought in by a firm, you have to shadow that firm, and then you can go. Even if you wanted, for example, if you had a MetaTrader license, you can do the MetaTrader dealer certificate. But if you don't have a MetaTrader license, there's no way to get the dealer certificate. So you already have to be working more or less or shadowing an existing dealer to actually get the certification. So there's a real informational imbalance, and it creates a situation where a lot of white labels, for example, in B2 Prime, we help people with their white labels, both institutional hedge funds and small brokers, and they might have a fantastic group of IBs, they might have a really good client base, but how they actually go about understanding, conceptualizing, and using the tools that they're given on their platforms is relatively weak. And something like the FX Dealer Academy is amazing. It's why I'm a very big proponent of it. Very happy to be part of that. But getting good information sharing across the industry benefits the whole of the industry, because CFDs don't have necessarily the greatest reputation. And I think that's because people enter into CFDs, they can't, companies, they might have misconceptualized their risk, people lose out. So I think having that level of education is really important. And most of the information that you get is a marketing exercise. There's very little that is, this is objective information that you can take and you can figure out how to run your business. Is actually very difficult to get hold of. So I think it's something that our industry really needs to grapple with.
Yeah, I think that standardizing is a good practice, like a certificate for Forex CFD dealers. Of course, I wouldn't say that it's hugely like necessary to do it, because there are hundreds of Forex dealers that they haven't any kind of certificates, but they fully understand. So you have to fully understand end to end the trade cycle, how it starts, how it ends, with that you understand that you are trading with a counterparty. If there is a certificate, for sure it will be on a good path. I'm not quite sure if it should be standardized that you have to be hired, you have to have this, some of the certificates, but it's always on a good path to be on a certificate to understand. I'll add what Antonis said, that most of the brokers, they have to educate their whole teams, like from bottom to top. Like even in marketing, they do have to understand what they are selling. Support, they do have to understand the risk. They do have to understand business development. They do have to understand it. So it's a core practice that it should be enabled on all of the brokers.
I know you are a mathematician. Am I?
Yeah.
Okay. So, what kind of a background do you think someone in dealing and risk should have? Because there is no such thing as
Yeah.
dealer's course in university, you know?
Yeah. I mean, I could be like a bit of biased, so I will say mathematics, physics, engineering. It will be for myself like the top. Then it will be like finance. So all these kind of things, they are adding a value, so that the dealer will understand how the distribution of my trades look like, what it means to have like an exposure of 100 lots, to be able to at least understand the things. So if I have to do it, I would put like five core fields like math, physics, engineering, computer science, and finance.
Lee?
Uh, I just think you need to understand the infrastructure that you're using. Yes, having a background in, you don't need to be a robotics major or a computers major to understand how the fixed trading language works. The way it works, you can see spec sheets everywhere. They're published, they're open. There's the and you can learn from reading it. So as long as you're comfortable with finding out how a trade engine works, how risk works. Plenty of people in the city of London don't necessarily have a background in mathematics, but absolutely work with risk. We're one of the biggest reinsurance and insurance backgrounds, which is my family's background. And there, a lot of people don't necessarily come from an academic background, but as long as you can understand the numbers, as long as you can understand the risk and model it correctly, um, then you're going to find your place in an industry working like this.
Antonis, you're the only dealer here, so I'm just gonna ask you one question because I'm curious. How much, how, what part of your job is actually standardized? Like the things that you do day in, day out, and how much of it is creative?
How much of it is creative or automated?
Oh, good question. Yeah, you answered that. That's better.
Sure. So day-to-day processes, I mean, we have standard tasks each hour, each 30 minutes, going through certain reports, analyzing certain clients. Um, but it's more of an ongoing, proactive kind of role. We should always know what our exposure is, not even every 30 minutes, every 5 minutes. We're always monitoring prices. We're always monitoring prices, server health. We always have the communication channel open, the bridge, for example, if something goes wrong. So I would say percentage wise, maybe 80% is standard in terms of reports, daily reports going through everything like that. And 20% is being able to adapt if something goes wrong and provide a quick fix.
Okay. Lee, you've briefly mentioned the gap between the dealing and risk departments and all other departments at the brokers. How do you think this gap can be bridged, and should it be bridged at all, or
So I feel very strongly that one is very much the same, because I feel like sometimes one, you have a risk department that looks at internally the health of the company, and then you have dealers who might be more customer facing and they have like a bit more of a role that's a sales, shall we say, role. And I think very much you have to have the two aligned together. So it doesn't make sense having them separated, although some companies do, and there's very good reasons why they do it. I think it works best when one is communicating with the other. This client, and also further down the line, how the communication with the client can then take place, because the risk and the dealing kind of need to sit together for the company to run well and for it to be profitable. So that conversation has to be very, very tight. Separating them too much, so you get a conflict between, hey, I want to price this client and they're doing huge volumes, they're paying us huge fees, but on the back end it's an impossible flow to place, can be very, very difficult. So understanding what flow you have, how you can manage it, what kind of feeds you can actually develop and support it. Can your LP create a bespoke pool that will actually be interested in pricing this kind of flow, and how that may perhaps slightly differ from the feeds that they're already seeing is paramount for that relationship with the underlying client to be successful.
Yeah, I think that the whole like it should be like kind of coordination between the whole thing. So even if you're a support, if you're like a business developer, if you're marketing, imagine like taking, I don't know, like a designer that they are doing like a banner for an ad. If they do understand what they're actually trying to sell, what's the characteristic of it, then this campaign will be more success. If you take like a business development that they are trying to give some IB relationship rebates, they could do, if they understand the risk, if they understand the spreads that they are holding, then they could actually give the appropriate IB rebates. That could actually help the whole organization. And in reality, the dealers, they should spread the information to the whole like office that they're working with.
Of course, they should be a genuine, and I think that's one of the misconceptions out there, especially when other departments start working for a broker or even sometimes liquidity sales, isn't there? That genuinely people don't understand the product they're selling, and they don't understand quite the maths doesn't math, if that makes sense, of what they're selling. And again, there is, and Lee, I know that's your favorite subject, the gap between the trade conditions offered to retail traders and what is actually available in the real environment, so to say.
Oh, absolutely. So a lot of the times when it comes to the retail environment, they might be looking at backtesting data. So they're looking at top of book data, gives them no information about depth. They've created some kind of bot that trades on that information. And then you get a situation like we had in October where silver was contango. There was a dislocation between the spot market and the futures market, reduced the number of LPs that could actually give you a silver price. And the silver swap for silver short positions was, I think, one day, if you were to hold that position for a year, would cost you 160% of that position. So unprecedented pressure on the silver market. Actually being able to hedge that silver was a real challenge. We had to use our own firm funds to increase the silver position that we had. I think a lot of tier one banks were caught out because silver went basically from 30 to 50 very quickly. Did they negotiate new net open positions so that they had the extra capacity to be able to hold the same number of ounces that they did 2 months ago? Coming from that side, it takes a long time. It's not necessarily very quick, depending on the PB, to get those changes through. So you get situations where there's a real dislocation between the actual market and your clients are expecting the environment to stay the same, or maybe they're using a hedging strategy, some kind of martingale box spread, and they don't understand that the cost of them doing business isn't the margin utilization, but the equity they have available on account. And they're not looking at equity in the same way at that moment. So they're not looking at how wide the spread goes because of adverse market conditions. They're not looking at how the swaps are consuming the actual margin account. So they really need to be aware of these things. But when you come at it from a purely quant background and you don't really understand the underlying market and the underlying participants for those markets, you get caught out, and it can be quite costly for hedge funds, retail traders, and everyone that you really need to understand the underlying market.
Do you have anything to add from
Yeah.
a quant perspective? I think you've been called out there.
Yeah, I mean, what I always say is that I would like to be as a quant trading like on some retail flow, like on some retail pricing. I mean, we see that we have on gold, like on a retail market, a spread of, I don't know, like 6-7 cents, and we always say as quants that we trade mainly systematically. Wow, that's super nice. But we do understand that it's not going to happen to us. Uh, I mean, if you're also like a dealer, and you do understand the quants and the maths behind it and what's the challenges, you can even actually explain it to your clients that, hey, that's the situation on the market. It's been done with this way and that way, and you can pass the message to the other side.
I think that's what unites us in a way, and that's why we've created FX Dealers Academy, because that's a bit of a non-for-profit project for us, because we're just trying to spread the knowledge about, and the bridge the gaps of knowledge in the industry in general. Antonis, I guess it's going to be our last question, and then we're going to take some more questions, but please feel free to add to it. What do you think, what is the set of tools that the dealers should be using, what they have in their in the brokerage to run the dealing desk successfully? What is the
Well, each broker is different in the way they operate, so there's no definite answer, but you should be using dashboards, internal controls, limits, nominal operating position if your broker does this. But number one, I believe, is managing your exposure. understanding, especially before news, using dynamic margin, how this can affect you. If you're 500 lots short, NFP happens, gold goes up $20, what's going to happen to you? So I think real-time exposure management is probably number one.
Okay, Lee, we practice this. What are the essential technologies to be used?
So it's definitely going to be your Bourse. That's which is supported by B2 Prime. That is one of our engines. But having that infrastructure in place so that you can see your markouts, you can see your client flows, you can see your positions, you can see how you group your clients, and understanding how other contingencies. So, for example, B2 B2 Core has an IB module. Understanding how that IB module affects payouts and profitability of flow is really important, because if you have an IB, you need to make sure that you're not consuming all of your alpha on your IB and you're leaving some on the table for yourself.
Oh yeah, my favorite, the rebate calculations, right? Please.
Yeah, I mean, rebate calculations, they always should be done. I mean, the dealers, they should know what's the rebate. They should know what's the spread capture, what's, I mean, ideally for us, we would like them to know, like, on a backtest level, like, what was the exposure, how this behaved. There were a few ticks away from, a margin call or whatever. Looking back the history can tell you the future. So ideally, they should have at any given point in time, like the spread capture for the whole company for on a user level and the the IP rebates.
Yeah, and unfortunately, there is a lot of times brokers forget that there is a cost of doing business, and their P&L is a function of spread, isn't it? Right. Should we take some questions from the audience? Oh, there we go.
We have a hand up.
Hello,
Hello.
my name is Steve. Question I want to ask is, how does AI fit in what you do? You seem to do a lot. You must remember this, remember that, do this, do that. But if you had an AI process, API or something, wouldn't that eliminate these thoughts and thinking that you've been doing on a day-to-day basis?
Yeah, I can see you're raring. Go on.
Yeah, I mean, on our side, like AI is a kind of day-to-day operation. So we're one of the first few teams back in the days, like at Tickmill. We ran our own like quants team internally, making our own hardcore like machine learning models trained on real GPUs or our own predicting the market. So one of the core things that I see at least the industry going on is that having some quants internally, that they actually have a view of the market. You don't have only, you actually classify a user as, risk or toxic or whatever, but you're only based on his profile. But the real question is, okay, do we have actually as a team like a view of the market? Where does the market goes? Is it with us or against us? So that's number one. And then of course, the LLMs, they do come in practice, but personally, I do think that we're a few years away, because it's like a costly thing to train like a huge model or even to fine tune it on
Reliable data.
yeah, on reliable data. So who is going to give the data, and then who is going to pay like this huge computational power, and then to sell it to whom?
Lee, would you like? Yeah, go ahead.
So from my side, I think if you look at the Forex industry and how it's developed over the last 30 years, it's very clear that, AI is very popular now, but the automation and the algorithmic side of the workflows has been a part of the FX industry, of the indices industry for a very long time. So, historically, I actually worked on a voice desk, actually dealing people on the phone. Probably one of the last desks in London to still do that. That's how I started my industry. But the way FX works nowadays is that you do have a couple of people who understand the underlying market and a load of programmers, and they develop and they have smart order routing and they figure out how to do things, whether it's looking dynamically at what's happening with the market and the markouts to respond correctly. So price makers are already using these tools, which I think many would class as AI tools. Maybe it's not an AGI, but it's definitely a
Machine learning.
exactly some kind of smart order router that looks at inputs and make decisions on outputs. And that's something that's been in the market since the early 2000s. Sentiment analysis bots have been here for a while, and it's automation has definitely been a part of this industry, and is part of what is making this industry profitable, because the spreads where they were like 30 years ago versus today on G7, it's a very big difference. And the difference is that you don't have a team of 100 people on the phone dealing everyone, but you have 4.
Steve, we answered your question. Fabulous. Any more questions? And we're 22 seconds over. Thank you very much. It's a pleasure. Very insightful. Thank you.